You probably heard this before. Time in market beats timing the market. And I agree with that mostly. But I also know that many of you want to buy more when the market drops and buy less when everything feels overpriced. The instinct doesn't go away just because someone tells you DCA is the answer. So today, I want to talk about something that actually bridges the gap. Not by telling you to time the market or ignore your instincts, but by building the system in a cost-effective way. This video is sponsored by Webull, and we haven't talked about Webull for a while, but they built something that I haven't genuinely seen on other Singapore brokerage, and it's directly relevant to what a lot of you are feeling recently. So let me walk you through it. And for those of you who are new here, my name is Chris, an ex-chartered accountant, now personal finance YouTuber, and I run a Telegram group of close to 23,000 members in the Honey Money SG Telegram. So you can join us there for like-minded finance discussions. Let's start with what most of you are already doing, the dollar cost average method, or we call that DCA. Every month, a same amount will be invested in your preferred stock or ETF. Set it up one time and forget about it. And yes, there's a reason why this is the most recommended approach for long-term investors. Because data has consistently shown that investors who stay invested through cycles outperform those who try to time entries and exits. So you remove emotions out of the equation. You avoid the trap of waiting for a perfect moment that may never come. And most importantly, it compounds steadily over time. So this has been the most consistent and beginner-friendly method to keep investing and stay invested for the long term. But here is the honest limitation of the standard RSP or regular savings plan. It has no awareness of value. Whether the market is at all-time high or the market has crashed, you are still investing the same amount every month or every fixed frequency, and it doesn't adjust. For a lot of you, it is fine, especially if you're a beginner and you're just trying out investing, trying to wet your feet. I think it is fine. And we try not to overcomplicate our investment strategy so that we can stay consistent. But for investors who have been investing for a while, you will have this nagging feeling, a sense that you are leaving something on the table when the market is giving you an obvious discount and you're not taking advantage of it. Moving on, I also want to talk about the feeling when the market drops, because very recently, in April 2026, with the uncertainty arising from the geopolitical tensions, the S&P 500 actually retraced back close to 10%. The markets moved really fast within days and sentiments turned really negative. And I bet a lot of you would have this feeling in your mind. I should be buying more during this market dip. Some of you may have acted on it. You have added funds manually into your brokerage account and executed the trade or the order. And you will feel very good about it because you have took opportunity. But for many others who have hesitated, maybe they feel a feeling of missing out. And they were probably waiting for things to become more certain before they have the courage to put in more money to invest. But by the time that you have convinced yourself to do it, the market may have already recovered at hyper speed. Or maybe your regular savings plan, just buy the regular $500 order, like didn't even take advantage of it, just a standard order. So I get that feeling because it is very hard to fight against the human emotions. Like, you know you should be investing more during a market dip, but your brain and your hands are not working out together. And it goes the other way too. When market is in euphoria, you realize that you should be investing lesser because everything feels really expensive and overvalued, but your mind is just keep asking you to add more, to ride up the wave of euphoria. But your standard RSP is also still not doing that. It is still continuing to execute that $500 per month. So in investing, you realize that the logic of buying more when things are cheaper and buying less when things are more expensive, it is not complicated. It is a very simple theory. But the hardest part is not always about the theory, but the execution, the practical. Because most people, they will do it the opposite way. They will invest more when markets are euphoric and invest less when market seems more uncertain. And there's nothing wrong about this because this is how human emotions are wired. So to really reduce this sense of anxiety and emotions, this is where Webull Dynamic RSP comes into play. Webull Singapore is the first and only brokerage in Singapore that has come up with this dynamic RSP feature. The core idea is straightforward. Instead of investing a fixed amount every month, Dynamic RSP automatically adjusts your contribution based on where the market is relative to its own recent trend. It uses a moving average as a reference point. Now you can think of moving average as a smoothed out picture of where the market has been over a set period, say for example 250 trading days, and that is roughly 1 calendar year. If the market is currently trailing below that average, it signals that things are relatively cheaper than recent history. If it's above, then things may be relatively more expensive. Dynamic RSP reads that signal and adjusts accordingly. Market below the moving average, your contribution moves up. Market above its moving average, your contribution goes down. So using a simple example with a $1,000 base amount, in a normal month, let's say we invest $1,000. So market dip below the moving average, you will instead then invest $2,000. But on the other hand, if the market runs above the moving average, you will just invest $500, which is much lesser. So you will realize that you're buying things more when they are on discounts, and you're pulling back when things are stretched. And all this is done automatically by Webull Dynamic RSP without you having to make that call in real time. Now I'm going to answer a very important question which some of you may have, and that is, why can't I do this myself manually? I can watch the market and manually adjust my RSP every month, correct? Technically, yes, but let's be realistic on how it will usually play out. Firstly, you will need to be checking the market quite regularly and follow all the market volatility because you want to make sure that you're not losing out. Secondly, you will need to have the discipline to top up your funds during a market correction period, which I have highlighted earlier is actually very emotionally challenging, especially when the news cycle is negative and your portfolio is down and now you're putting in more money to bleed it out. Number 3, you then need to remember, you need to pull back when the markets are on an euphoric trend, which goes against the human natural instinct to add in more, especially when things are looking really good and all your stock prices and ETF are at all-time high. And the most difficult part is actually the execution. Like you need to fund your brokerage, you need to set up your trade order, and then you need to look at all these things to execute your trade. Because I fully understand that all of us are busy, we all have jobs, we all have businesses to run, we have people to meet, we have families to feed. And maybe even the people who already have the intention to do it, they are not doing it consistently because sometimes things get away in life. So this is the actual problem that Webull is solving because the concept is not new. It is a very simple concept. But I think the difficulty is always the execution, especially with human emotions and discipline in play. So in simple words, Webull Dynamic RSP automates the execution so that the strategy runs the way that it is supposed to do. So let me show you how to set it up on your Webull mobile app. So on your Webull app, tap on your favorite stock or ETF, for example, QQQ. On the bottom right, tap on the 3 dots, then select regular savings plan. On the RSP page, you will see fixed amount and dynamic amount. So for the purpose of dynamic RSP, we will select dynamic amount. So you can start from 20 SGD, but I will say for demonstration, I will use a 1000 SGD order. And you can see payment method is deducted directly from bank. So you don't even need to manually fund the brokerage account. And so far, it is the same step for the standard RSP. So you'll select your frequency every week, every 2 weeks, or every month. Date, I will use an example of the 15 calendar date. But here is where it starts to get different because you have something called the trace setting. So on the benchmark, you could use an index or an exact stock. So since I'm doing the RSP on QQQ, I will just follow the Nasdaq index. For moving average wise, I will choose 250 days. So the difference is that shorter periods reacts faster to market moves, but longer periods give you a slower, smoother signal. So I would say that 250 days is a sensible trading point because it roughly captures one full trading year without overreacting to short-term swings. Once you have filled out everything, click on next, then confirm the order. And now you can see that your dynamic RSP is already set up. So along the way, you can either cancel or modify the order according to how much you want to invest or you want to change any of the settings. So that's about it for the mobile app demonstration. But I want to zoom in on something that most people don't think about, and that is fees. If your contribution is adjusting dynamically, whether the market is moving up or the market is going down, you may end up transacting more frequently than the standard RSP, especially during high periods of volatility when the plan is doing exactly what it is supposed to do. On a platform that charges you commission per trade, the more you trade, the more fees that you're going to pay as commission or platform fees. And I'm very sure that the fee drag will erode any form of advantage that you're trying to gain from dynamic RSP. Because you will realize that you're paying more to buy more orders at lower prices, which overall reduces your net gain, and we call that the fees drag. And here is where Webull's pricing structure make this very advantageous, because if we look at the current pricing, US stocks and ETFs on Webull will be charged 0 commission and 0 platform fees. No minimums, no conditions, and no expiry. And this applies to everyone, not just new signups. So when dynamic RSP increases your contribution during a correction and you are transacting more during that month, nothing is being taken off the top. The full benefit of buying at a lower price stays with you. And separately, if options trading is part of your strategy, Webull charges commission of 55 US cents per contract. So yes, after going through so much, I want to highlight a bit on the pros and cons and be upfront about it. And I want to be clear that dynamic RSP is not for everyone. And I rather you go in with clear expectations. Where dynamic RSP really works well is when you already have a regular investing habit and you are already comfortable with how RSPs work. So dynamic RSP lays a useful structure on top of it. It gives you the systematic way to act on market moves without having that emotional load. And this is especially during market volatile periods like recently, where sometimes we may feel the paralysis of should I top up my funds and invest right now? Or should I wait longer for a better opportunity to enter the market? And it is also really convenient to set it up, plus the fees are zero. So you're not penalized on letting it run actively. But honestly, on the other hand, I felt that the dynamic RSP is not really suitable for beginners when you're still trying to find your way to investing and you're learning the beginner steps. This kind of variability can add more confusion and overcomplicate what you're trying to achieve. So I would say it's more important to build the fixed habit first, right? You always do the basic steps, and once your basic steps are solidified, then you move on to more advanced strategies. And if you're already investing with a very tight monthly budget set aside, then I think that increasing your contribution during a market volatile period may strain more on your cash flow. So ultimately, to execute this dynamic RSP properly, you will still need to have some cash buffer. And most importantly, dynamic RSP is not a market timing guarantee. It is a systematic approach to adjust how much you want to invest during a market up or market down period. It does not help you predict the market bottom nor help you time the market top. And especially during a very long bear market period, you will keep seeing your contributions increase, but the stock price or ETF price keep falling. So there's a lot of conviction needed for you to hold on to your positions and not suffer through the meltdown. So you will need to set the right expectations when you're doing a dynamic RSP. But if this sounds interesting and you really want to explore this feature, then I would really encourage you to sign up for a Webull account using my referral link, where I'll put it in the description also, because you can get up to 1,888 Singapore dollars in free shares plus stock trading vouchers when you open and fund a new Webull account by 30th of June 2026. Dynamic RSP itself starts from $10 US per order. So I'll say that testing it with a small position first just to try out that feature would be reasonable if you just want to see how it behaves before you commit more. So if you have any questions about the configuration, what index to track, how many days of moving average you should use for your order, do drop them in the comments and I'll go through them. Also, if you like investment content like this, remember to subscribe, like the video and share it to your friends and family so that others can benefit from this as well. And if you want to check out a related investment video where I map out how do you invest as a beginner, then I can refer you to a previous video right here.